Chapter 5, Part 1, Inventory Valuation. In this section, we're going to look at specific identification, FIFO, LIFO, and weighted average. Now, when recording and measuring inventory, there are two types of inventory. One type of inventory is we buy completed goods and we turn around and sell them. This would be something that is what Target mostly does, or what Costco mostly does. Manufacturing inventory is when people buy all the goods and then create something and then turn around and sell it. That's a manufacturing inventory. Much more complicated to account for, and this is what we study in managerial accounting. So this gives you an example of what it looks like. If you're a merchandise company, everything goes into one account, inventory, and when you sell it, it goes to cost of goods sold. When you're in a manufacturing company, you buy goods into raw materials. Then as you use them, it goes to work in process along with labor and other costs. When you finish them, they go to finished goods, and only after finished goods do they go to cost of goods sold. Now we have two accounting systems. Our focus is perpetual, which means the inventory account is continually updated as purchases and sales are made. Now we're going to look at 4 different inventory methods for transferring costs out of inventory to cost of goods sold. We have specific, first in, first out, FIFO, LIFO, and weighted average. So FIFO assumes costs flow in the order incurred. LIFO assumes costs flow in the reverse order, and weighted average assumes cost flow at an average of the cost available. So we'll start with looking at specific identification. Assume that the cost assigned to an inventory item when it is sold is the actual cost paid. Cost of goods sold represents the actual cost of the goods, and the ending inventory represents the cost of the goods. The costs flow exactly the same as the physical inventory. Now, regardless of what method you're looking at, the first thing you should always do is figure out what's the total cost of goods available for sale. And you would always start with your beginning inventory plus purchases. And that would tell you what your total cost is. So in this example, our total units available for sale are 3, and the cost of goods available for sale is 48. So what we're trying to do is figure out how much of that $48 goes to cost of goods sold and how much stays behind in inventory. So we'll start with specific identification. All right, we sold the May 10th unit. That cost goes, and the item goes to cost of goods sold, and ending inventory is going to be 32. That one's pretty easy. Next, we have FIFO. We assume that the earliest inventory costs are assigned to items as they are sold. The cost of goods sold represents the oldest cost. Ending inventory represents the most recent cost. This is what most companies use. So oldest costs go to cost of goods sold. Recent costs are in ending inventory. Now we'll go back to our same problem. We bought 3 items and we sold 1, so we would take the May 1st, which is our oldest cost, and that would go to ending inventory. Now, here's something you should remember. If I instead had sold 2 units, I would only be able to price one at $12, and the other unit would have to be priced at $16. So remember, you can only transfer the amount based on the number of units you have available at that price. So you work down. You start with the oldest cost, and as you're selling units, you work down and eliminate the old cost as you go. So in this case, we sold 1. Now our ending inventory is going to be 36. So of our $48, 36 is an ending inventory and 12 goes to cost of goods sold. Last in, first out assumes that the most recent inventory costs are assigned to the item as they are sold. The cost of goods sold represents the latest cost. The ending inventory represents the earliest costs. Now, again, just so you know, under the international standard, you cannot use LIFO. And that's one of the many reasons that we did not converge with the international standard, because in accounting, we have GAAP, which is what we use in the United States, and then there's the international standard that's used everywhere else. We tried to merge, but we couldn't. And one of the reasons is we would not get rid of LIFO. So, again, we have our example. Now, in this case, we sold one on May 26th. We would have to use the most recent cost, and the old cost would stay in inventory. So now, again, there's our $48 with $28 in ending inventory and $20 to cost of goods sold. Now, what about weighted average? Here we assume that a weighted average cost per unit of the entire inventory purchase is assigned to items as they are sold. But remember, because we're doing perpetual, you have to calculate this average cost every single time you make a sale, so that average cost is changing all the time. So when a unit is sold, the average cost of each unit inventory is assigned to the cost of goods sold. Now in our case, we have the 3 units. We sold one at the end of the month. So what that means is we have to include all 3 of these in our cost divided by units, which gives us an average cost of $16, and that would be the amount that's assigned to cost of goods sold. And the ending inventory would be 32. Now, if instead we had made that sale on May 11th, our average cost would change, because in that case we'd have to divide the 12 plus the 16, which gives you 28, divided by 2, which means your average cost at that point would have been $14. So remember, it changes every single time you do your average cost. When prices are rising, FIFO matches low cost with current higher sales. Inventory is valued at approximate replacement cost, results in higher pre-tax income. LIFO matches newer costs with current high sales. Inventory is based on older, results in lower pre-tax income. Now remember, LIFO is not accepted in the international standard. So one of the questions I get a lot is, which method do you use? Well, a lot of it most people use FIFO, I'll tell you that. How closely do reported costs reflect actual flow of inventory? How are income taxes affected by inventory choice? And how well are costs matched against related revenue? Believe me, inventory is a very complex topic, and we go into it in great detail in managerial accounting and in intermediate accounting. And that ends this presentation. I hope that helps with the homework.